So let's work these bonds. Here we have a company issuing 800,000 5-year bonds at 8% payable semi-annually. This is describing what's in the bond contract. This is describing what this firm is willing to repay and tries to attract investors to come and buy their bonds. And so if you loan me money now, this is what I will pay you back later. And the investor decides how much they're willing to give them for this promise of $800,000 at maturity and 8% interest payable semi-annually between now and maturity. So let's see what we need. The interest payment amount is based on what's in the bond contract, not what the market wants, but what's in the bond contract. So the bond contract indicates that the borrower will pay 8% to the holder of the bonds, with half being 4% the first 6 months and 4% the second 6 months, semi-annual. And so there'll be 10 bond payments, 5 years, twice a year. That's the bond contract. So what is the amount of the interest payment? It will be the $800,000 times that 8% divided by 2, because you're going to pay half twice a year. And then at maturity, the bond contract says you repay the $800,000. Whether you got the $800,000 at the beginning or not, whatever you valued it at the beginning, you still must pay the bond contract at maturity, the full $800,000. How many periods? Well, there, the number of payments tells you the number of compounding periods. So here, there'll be 5 years and twice a year. So 10 periods. Now, to come up with the bond price or the proceeds that the investor will pay you for this future cash flow stream of interest payments and then payment at maturity, what the investor will pay, what the market will allow, is based on the market interest rate. So I didn't touch the market interest rate in figuring out the $32,000. I'm only going to use the market interest rate when trying to value how much is this future promise worth today, because that's when the investor is going to be purchasing it, today. So the market rate per period, since it's semi-annual, will be 5%. 5% every 6 months. Now, table factor. What I need for the interest payment is not the same as what I need for the maturity. The maturity happens one time at the end of the 5th year. The interest payment happens every 6 months, over and over 10 times until the bond matures. So that's an annuity, equal payments, equally spaced apart. So I'll be needing the present value of annuity table, because that is where the loan starts and is paid out over the next 5 years with 0 at the end. So I'm going to use that present value of annuity table. I'm going to look up 10 periods at 5% on both the present value annuity table and then the present value of $1, because the maturity payment only happens once. Let me go and get that. So here's the present value annuity table. My market rate was 5% over 10 periods, so 7.72173. So I have that one. Now I want the present value of $1 table. Same thing, 5%, 10 periods, 61391. So I now have the factors. You can see the cheat sheet here in red, that to get the present value of the interest payments, I need that interest payment times the present value of annuity factor. And to get the present value of the one-time maturity payment at the end of the bond, I take the face amount times that present value of $1 table. And so I add the present value of both because the bond document promises both the interest payments and also that final payment of the face amount of the bond at the end of the life of the bond. So the way this would work is that cash would go up because that's what the investor paid you for the bond, and you would record bond payable at par, and then you'd either have a discount if the issue price was below the bond amount, or you'd have a premium if the issue price or proceeds from bond were above the par amount. Here we got less than the bond payable face amount, so we have a discount on bonds. So the net liability, or the carrying value of the bond on the day it's issued, will be what you got from the investor. Why is it less than the $800,000? Because the interest stream that you promised was too small. The 8% is lower than what other firms are paying. The other firms are paying 10%. So they would just ignore your bond issue and you wouldn't be able to get a loan. There would be nobody that would come and be interested in your bond. So you dropped the price at the beginning. You can't drop the price at the end because that's written in the bond contract. And the bond interest rate's already written in the bond contract. So the only flexibility you have is to accept less than $800,000, even though you're going to have to pay the full $800,000 at maturity. So that difference, that $62,352, is a enticement that I'll pay you a little bit of the interest up front to make up for the fact that that 8% is too lean. It's smaller than what other firms are paying. But I'll make it up to you by letting you pay $62,000 less up front, and you'll get the full $800,000 at the end. And so that will make up for that $32,000 being too small compared to what other people are paying. Let's do the next one. We have the same bond contract. Notice that line is exactly the same. The only thing that has changed here is that the market rate is no longer 10%. So the interest payment is the same. What you repay at maturity is the same. It's still 10 periods, 5 years, twice a year. But the market rate is not 10% now. It has dropped. It's now 4%. And so that would be 2% per period since it's semi-annual. Now we have to go get different factors. Now we need 2% at 10 periods. So 2% at 10 periods would be that 0.82035. And then for the present value annuity, we need a different table. There we go, 2% of 10, 8,98259. And so now we take the amount times the present value factor for both interest payments and the lump sum at maturity, and then add those up. And now the investor is willing to pay more than the face amount. This is a premium bond. Why? Because now the bond interest stream is much heavier, much larger than what other bonds are paying in the market. And so you got to stampede and they bid the price up until that premium all of a sudden is just starting to be too rich, because here they paid $143,000 more than face. So at some point, they're not going to bid it up any longer, because that's a big extra to pay you to get that $32,000, even though other people are not paying anywhere near the $32,000. There is a point of equilibrium where they won't pay anything more than that. And that equilibrium is the market return. So to record this, Let's record this one. So you would get the $943 in cash. That would make your assets go up. The liabilities are going to go up and be recorded the par in the bond payable account. And now we have an adjunct account. It's not a contract account. It's an adjunct account called premium on bonds payable. And this will increase the liability account. It's an adjunct to bonds payable, the premium on bonds payable. Let's just do a bit of theory now. We have two bonds here. And so the question is this a discount or premium bond? So that's a lot of numbers on the page, and we didn't ask you to calculate any of them or even check them. But you can see here the initial loan, when they initially loaned it, the book value, which is the par minus discount or the par plus premium, is $917,000. And the face is $800,000. So this 117, is that a premium or a discount? It's a premium. It's being added to the face. And so that's a premium bond. What does that mean? That means that the interest stream promised in the bond document is much richer than what the rest of the market is paying. And so investors not only would pay you $800,000, but they pay you even more to get that heavier interest stream. What about this one down here? Net book value on the day of issue, $748,000, but the face is $800,000. This is a discount bond because the carrying value is below it. What that means is that the bond contract rate was worse than the market. It was lower than the market. It was leaner than the market. And so nobody would be interested in the bond you want to issue, the amount you want to borrow, because it's not competitive in the marketplace. So you have to start giving them a deal. Okay, how about you don't pay the whole $800,000 up front? Well, how much lower? They would go down to the point at which this bond is competitive with other interests, other opportunities, which would be market rate. Okay, let me know if you have any questions.